James, how did the Harmony portfolios fare in July?
Well, July, as you know, was a mixed and volatile month again. We had a couple of bouts of quite strong markets, followed by some weaker moments, and overall the month, the equity market traced essentially a W shape through the month. The final week improved matters quite a lot as Europe came to the party, if you like, again, led by Mario Draghi, the ECB, suggesting once more that there is more firepower to be thrown at the European problem should it be required. And so overall, risk assets positive over the month, and that resulted in positive absolute returns for all the Harmony funds. From a relative point of view, performance was a little more mixed, particularly those funds where they had a stronger local government bond market or a stronger local currency, making your foreign currency returns, translation back into your reporting currency a bit more tricky, but generally a pretty reasonable month.
You've spoken there about currencies. What were the other main drivers behind performance last month?
Well, equity was positive, and as we've mentioned before, we are broadly neutral on our equity exposure, both within the local equity component, the global equity component, and also the emerging markets component. Now, emerging markets outperformed global equities slightly, so we benefited from that, although with hindsight, if it had been overweight, it would have been better, of course. But low single-digit returns from the global equity market generally benefited performance. And our main position in the fixed income is to be underweight government bonds. Europe and the UK actually outperformed the US Treasury over this period, so that's just worth bearing in mind for the UK and the European funds. All of them returning positive returns in local currency, and global bonds, global government bonds, actually not far behind global equities. So there wasn't as much value from asset allocation in a month such as this as you might otherwise hope for. Where we did do well, high yield, where we're overweight across the entire range of the Harmony funds. High yield outperformed both global governments and the equity market. Investment grade also benefited from the government bond component of that return, if you like, their sensitivity to the government bond market, so they did okay as well. Convertible debt underperformed actually. That was a bit of a disappointment for us. In a month where equity did quite well, we'd expect a bit of a better result from convertibles, especially when high yield and investment grade did well as well. Finally, property securities once again had a very strong month. We are mildly underweight that sector now on the basis that we think it's expensive. It's outperformed global equities in a broader sense quite materially over a reasonably protracted amount of time now, and to our eyes it's looking a bit expensive. So we're underweight there by about 2%, which is not a massive position, but it's enough to have an impact on returns over the short period such as July.
You've spoken there about the returns to listed property. Were any other major changes made to portfolios last month?
We've been quite quiet in the portfolios this month. We made a few small tweaks in June, the main one being adding inflation-protected securities, government debt, which is inflation-linked in its returns, either through US TIPS or through the UK gilt market where appropriate. The US TIPS, for example, outperformed their nominal government counterparts quite materially, so again that's a positive attributor to performance. But as I say, overall we've been reasonably quiet in terms of portfolio activity over the month. We're pretty comfortable with the position we'd established in June and happy to carry that through throughout July.
And looking forward, James, what do you expect?
More of the same really, in the sense that we expect a sort of growing anxiety to be followed by intervention, to be followed by growing anxiety again. The trick is to try and be nimble and play those sort of mini cycles, if you like, reasonably actively. To that end, we're looking at our equity exposure now, although we're not expecting to necessarily cut soon. Having bounced in the order of 10% from lows in June, we think maybe we're coming towards a reasonable point of taking a small amount of profit again, but it won't be a wholesale risk reduction in the portfolios. It's really just a marginal tweak at these kind of levels. The reason for that is that overall valuations aren't particularly stretched still, looking across the equity markets. And while the macro scenarios playing out in Europe, arguably the US as well, and clearly China have an important bearing on the portfolio's returns, ultimately valuation has to be the key driver of how we position the portfolios. So in summary, remain nimble, dynamic in your asset allocation, remain valuation focused, and on the occasions where in the short term that doesn't necessarily pay dividends, to both continue to critique what you're doing, but at the same time, if you think you're doing the right thing, then sort of stick to your guns really in these sort of markets.
James, thank you very much.
Thanks, Richard.